The much-anticipated OPEC meeting on May 25th came and went. We did get an output extension agreement as widely expected, but oil markets aren't impressed. So joining me now is Keith Bliss of Cuttone Co. Keith, great to have you here.
Thanks, Remy. Always good to be with you.
Well, there was plenty of speculation ahead of the OPEC meeting and plenty of rumors. But now that the meeting is over and we did get a 9-month extension cut, oil markets aren't altogether surprised. And some people had been factoring a greater possibility of an extension, as well as the amount of oil that would be cut on a daily basis. So are you bearish or bullish or neither right now?
I'm neither. I've been saying for some time that I think oil will be stuck in a range somewhere between $45 and $60 a barrel, and certainly we're seeing that. You know, the news came out of extending the cuts or the levels of where they are. They're not cutting further. They're just extending the production levels now for another 9 months, and the oil market yawned. In fact, it's down a little bit as we're speaking right now. The problem that OPEC has, and Saudi, who is the de facto head of OPEC, the problem that they have is twofold. Number one is there's still a glut of oil on the market, but yet they need to try and raise prices, get prices up as they prepare to take Saudi Aramco public, and also their export revenue has dried up a little bit. And then the second problem is that U.S. shale oil producers have figured out a way through technological advances over the last few years where they can produce a barrel of oil. By some estimates, their break-even price is around $34. So OPEC and its non-OPEC partners like Russia, Mexico, and some of the others can limit the spigot all they want, but when they do, the void, about 2% of the daily supply, that void is being filled nicely by U.S. producers.
And Keith, since you brought up U.S. shale producers, I do want to ask you about what we got out from the White House budget for 2018 earlier this week. Now, part of that did come as a surprise, in which the government could sell part of its oil reserves. So did that come as a surprise to you?
No, it's not. I think when you take a look at the Trump administration, like them or hate them, one thing that they will be when it comes to monetary and fiscal and budgetary types of issues is they're going to be pragmatic, and they're going to look at everything on where to cut the expense or maybe increase revenue. When you take a look at how the world is shaped today, particularly around energy, the emergence of alternative energies, the emergence of the U.S. ostensibly being energy independent, do we really need the strategic petroleum reserve to be as big as it is?
And last but not least, we have a holiday weekend ahead of us here in the U.S., but we have a G7 leaders meeting in Sicily. Now, here in the U.S., Monday is a holiday, but we do have a lot of data coming out next Friday, as well as Thursday. And, of course, the jobs report is in the spotlight, especially in light of the Fed meeting coming up. So what do you expect to see?
Well, I think the markets will continue to trade sideways. They have been. I mean, if you look at, for example, the Russell 2000 index, the 50-day moving average on that going all the way back to February has been nothing but a flat line. The markets have gotten to a point where we are grinding a little bit higher here. We'll see if we can hold breaking out on some of this overhead resistance that we've had here. But as it relates to the macro data leading into the June Fed meeting, the Fed in the minutes yesterday pretty much signaled that they're going to, raise in June. If the data supports that we get next week, including the jobs, you can put that in the bank. It's going to happen. And I think the markets will continue to react positively to that.
Okay, Keith. Well, thank you so much for joining me today, and thanks for your insight as always.
My pleasure.